So trading is a game of information. Unfortunately, the information is not transparent. A lot of information why people are buying and selling is unavailable to you. A lot of the order flow that is happening in the market is unavailable, and that is something that is just a part of the game that you have to kind of get with, and so you have to learn to adapt around that. Now, with that being said, order flow is the most proximate driver of price action. We have access to information by price action. The price action is reflective of the order flow. In this video, I'll share about how financial institutions going to create order flow. They're gonna create an actual positions in the market. If the order gets activated, then that order becomes part of the order flow and therefore approximate driver of price actions. If it never gets activated, then it just remains as potential liquidity. Okay, so after watching this video, my expectation is you begin to concentrate all your efforts on what really matters. Every movement that price makes, interpreting it and putting it together to help you make the best trading decisions possible. Now, most traders fail because they take the wrong step in the beginning of their journey in market. They learn candlesticks, market structure, indicators, fundamental, risk reward, and so on. But then after all the time they spend to learn those stuff, they'll still be difficult to get profit in the market. They then just become another testimony for the public. You know that market is a dangerous gambling game. 70% people lose money in market, maybe more. How come? They have wrong mindset from the beginning. They repeat mistakes again and again. Early entry, bad stop loss, non-realistic target profit, trade large size. Start with small capital but trade in market like a trader with $1 million. Hey, don't follow the way. If you still new, it's good. You come to the correct channel that will teach you the proper steps to become a trader. If you belong to that 70 loss trader, now it's time to change that. It's never late to start again. Okay? Now, you learn and focus first to the why, the trading logic, how the institutions, the big boy, place their order in the market, how they manage the trading, how they behave in market. Okay? So this is your first knowledge to understand before learning anything else, and this is the main focus of this video. Now, all movements in any market are caused by the institutional. These big boys have a lot of money, so that their trading transactions in the market are able to make price go up or down. They are the ones in control of the market. They are banks, investment managers, governments, large companies, large institutions. Okay? So, roughly 80% of all the currency volume is transacted by only 10 financial institutions. They have the absolute majority. They move and manipulate the price. Market is their game. It's not just the forex market, it's the same for all trading instruments. No matter that this particular market is quite new or not, still the big financial groups dominate, manipulate and move the market. And you and I are pretty small. We cannot move the price, we cannot manipulate the markets, but we can still be profitable. What we need to do is just accepting our role in this game. We need to keep an eye on the big boys, the institutions. And how do we do that? How do we track the institutions? Well, we track them through price action in our chart. Okay? Price action provides us with clues on what the institutions were doing, what they are doing right now, and what they most likely will be doing in the future. All of them we can see on our chart. Okay. Now, These big banks often use events that happen in the market as a tool to move their money for long-term purpose. Now let's assume that I am a trader from a big institution and I have an exclusive information that USD will be strong in near term. Unfortunately, other institutions else also knew this piece of information earlier than me, and the price has been starting to go up rapidly like this. Okay, but I want to be part of this and I really want to enter my position. However, this is happening too fast. The price already go up. So to make sure I will be able to jump into this new trend, I need to create a scenario. Okay. Now I know that Bureau of Labor Statistics will release CPI on Tuesday 12, 2020, and I use this to make price going cheaper for me. How I do that? Well, it's simple. When the day comes, when the economic information release, and when price near less resistance, I use it to enter a short position. Here 300 lot with market order. I aggressively sell. The market down because of this. Okay, but retail buyers still try to move up the price because they still think the uptrend exists. Okay, so once again I attack market with market order short 200 lot, and I am ready to add one more position to drag the price down. And luckily other institutions does not want to fight, they also want to take their profits, and then their actions also make market down more, and it's good for me. Okay, now the retail traders then believe that trend changes, so they also jump in short position, making market down and down more. Okay, now finally I have a chance to enter my 1000 lot long position when the price already at discount level. Here in the level of price I wanted, I start to enter my market order. This of course make market up, but not much. I have to make sure that retailers still believe downtrend holds, and they did. They still try to sell. Okay, this once again give me a chance to long again, and I entry my market order 100 lot. Okay, this time my action make price up again, and price starts to move up. Retail traders still believe the downtrend still hold, and they make price lower again. So this brings me another opportunity to go long again. I enter again 300 lot for buying, and then other institutions add their position as well in here, and they also be aggressive. Market flooded with long orders, and this then triggered the stop loss from sellers. Okay, making market up more and more, and now market knows the trend changes. They also jump to buy, and it then make market up more and more. Okay, this is more or less how the big banks, big boys work in market. If you understand this logic of trading, you'll be able to see market movements with different eyes. It gives you a clear market structure that will enhance your decision making process. Now the question maybe arise in your mind, how we know when the big boys do their activities, correct? Now we have two things to give us information about the institutions activities in market, but in this video I just mentioned two of those three. Okay, these two things you have to pay attention when looking at the chart. The first is ranging area, because you know the large funds managed by the big boy, so they always need time to enter the large market orders, and they always do it slowly, subtle and hidden from others. And the best way to do this is to disguise themselves into small investors who randomly place lots in smaller amounts when the market stagnates like this. Okay, now this is also a ranging area. The big boys doing something here, and they put their short order in order to continue the bearish trend. Okay, now when I see the ranging area appear in my chart, I always say to myself, hey, wait a minute, now the big boy is cooking. Now what is their plan now? Is it they want to continue the existing trend, or they want to create another trend? Okay, so this question to myself make me calm and more patience to it, make me want to see the movement of the price in more detail. Okay, so you have to remember, whenever you see a ranging area, you have to take back your step and start to think, hey, what is going on? What is happening in the market? Okay, now I will explain about it in detail later. Okay, now the second thing you use to identify the institution is market rejections. It is so important for us as a trader. Okay, now it is a situation where the market refuses to go up to a higher level or refuses to go down to a lower price level. Let me give you an example. See this candle. Okay, now it's telling you that the institution aggressively buy and has rejected lower price. The buyers in control. Okay, this is what I call a price rejection. And you see, after the institutions hold their market order, the price go up. Okay, now let's take a look at another example of rejections. Here we also see a rejections, market refuses to go up in this case. This is also the activities of institution. They shorted at this level. Okay, here we see another rejections. The institutions this time shorted. Okay, this also a rejection. Okay, now this one's also a rejections. In this case, the institution take profit from their last short position. Okay, and then after that, what they do here, making the price go higher. Okay, now this cycle of the market always happening every time. Okay, why the price move up? Because the big boy wants to have price that they want here. That's why they start to make the price to go up like this. okay, by realizing they're taking profit, or just add a small portion of their money just to make sure to convince retailers in market that this is uptrend, you have to buy. So all these amateurs in the market will give liquidity the big institutions need to fulfill their short order here. Okay, I hope this makes sense to you. Now let's take the logic of this big boy way of thinking into our chart. So the first thing you have to look at your chart is ranging area. It is an area where price has spent most time trading at an area where buyers and sellers both agreed that this price area corresponds to their current expectations. They are happy leaving the price at the current level. They consider it a fair price at that moment. Now let me give you an example of this. See this ranging area. I will draw a rectangle and then zoom in. Okay, as you can see here, both buyers and sellers feel comfortable leaving the price rotates up and down over and over again in this area until further fundamental development changes. You also see the rejection price here. The price could not close above this rejection area. This is a strong resistance. You see here, the price also could not close above these areas. Then institutions come and bump buyers, making price lower. This is also a ranging area. We have a price rejection here. The institution shorted here. See how bears cannot above this resistance area. Notice again that after market ranging, the movement will then happen. Big boys aggressively flood market with their large market order and creates a condition where supply exceeds demand. Price goes lower to find equilibrium between buyers and sellers, creating value of price. You will find this pattern happen in all charts over and over and over again. So remember this: whenever you see ranging market, you see institution builds their market order, and whenever you see market rejection, you see institution place their market order there, and when they finish, they will move the market. Okay.